This is John Persinos, Editorial Director of Investing Daily, with a video update for Tuesday, May 19, 2020. Investors are unnerved these days, to say the least, by the latest economic data. Let's take a quick look at where we've been and, more importantly, where we're going. The U.S. economy is on track to post a massive loss from the coronavirus pandemic in the second quarter. We got a glimpse of the damage from first quarter data, which showed a 4.8% decline, but we're due to take a much bigger hit. The median consensus estimate now calls for a whopping second quarter contraction of 31.6%, the worst quarterly decline since the end of World War II. The economic news already has been abysmal. The U.S. Labor Department reported last week that more than 2.9 million Americans filed unemployment insurance during the week ending May 9, exceeding expectations at 2.7 million new claims. The new claims brought the total to 36.5 million Americans over the past 2 months. Those are levels of joblessness we haven't seen since the soup kitchens and bread lines of the Great Depression. The jobless numbers this week are expected to be bad as well. The Labor Department reported last week that the U.S. Producer Price Index, that's the PPI, declined 1.3% last month, the most since April 2009. In the 12 months through April, the PPI decreased 1.2%, the biggest drop since November 2015. The plunge in economic activity caused by the coronavirus is generating a phenomenon called deflation. That's something that afflicted world economies in the 1930s. It's bad overseas as well. The European Union last week reported that industrial output in March in the Eurozone, those are the 19 countries that share the euro as a common currency, was 11.3% lower than in February. That was the largest month-to-month decline since records began in 1991. Make no mistake about it, folks, we're in a recession. On the docket this week are key reports that will provide further clues as to the severity and length of that recession. Take a look at the table. The key reports you should watch will get released Tuesday through Thursday. Because of the general lockdown throughout the U.S., analysts predict that U.S. gross domestic product growth could fall by as much as 40%, the sort of decline we experienced during, the Great Depression. Unemployment this summer could reach 30%. Those are frightening numbers. The question now is, as states start to incrementally open up their economies, will recovery be swift or agonizingly slow? Will we see a V-shaped recovery, a W-shaped recovery? It's impossible to say. The numbers this week will provide some clues. Keep an especially close watch on Thursday's jobless data. It's expected to be terrible, but if it's better than expected, stocks could soar, of course. So we got market-moving data ahead this week. Regardless, it's likely that the jobs data are understating the extent of unemployment. It's also possible that as the pandemic retreats, businesses that were fundamentally healthy before the coronavirus outbreak will reopen, rehire, and return more or less to normal. We'll see. In the meantime, elevate your portfolio's cash levels and increase your exposure to safe havens such as utility stocks, consumer staples stocks, and gold. Stay cautious, stay invested, and stay safe. If you have any questions or comments, you can reach me at mailbag@investingdaily.com. Thank you.